Today, we will talk about leveraged buybacks. A leveraged buyback is a corporate finance transaction that enables a company to repurchase some of its shares using debt. Reducing the number of shares outstanding increases the remaining owner's respective shares. Leveraged buybacks have similar impacts as leveraged recapitalizations and dividend recapitalizations, but they differ in that they do not change the ownership structure. Theoretically, leveraged buybacks should have no immediate impact on a company's share price, net of any tax benefits from the new capital structure, and higher interest payments. But the extra debt provides an incentive for management to be more disciplined and improve operational efficiency through cost-cutting and downsizing, in order to meet larger interest and principal payments. Leveraged buybacks are sometimes used to decapitalize balance sheets to avoid overcapitalization and can provide protection from hostile takeovers. However, more often than not, leveraged buybacks are used to increase earnings per share, return on equity, ROE, and price-to-book, P/E, ratio. Boosting EPS through leveraged buybacks can be beneficial for companies, but it does not signify an improvement in underlying performance or value. It can even do damage to the business if financial engineering comes at the expense of not investing capital productively for the long term. Financial markets have rewarded companies using buybacks as a substitute for operational performance improvement, leading to their popularity since the global financial crisis. From 2008 to 2018, U.S. companies spent over $5 trillion buying back their own stock, and for large companies like Procter & Gamble, Mondelez, and Eli Lilly, approximately 40% of EPS growth has been a result of buybacks. In 2017, leveraged buybacks made a big comeback in the U.S., and they were used to avoid repatriating cash and paying U.S. taxes. The buyback boom increased the risk for both bondholders and shareholders, with even investment-grade companies willing to sacrifice their credit ratings. Rising interest rates and potential tax changes have the potential to impact leveraged buybacks. In his State of the Union address in February 2023, President Biden said he would propose quadrupling the tax on corporate stock buybacks. There were also suggestions from SEC Commissioner Allison Herron-Lee in 2021 in support of corporate share repurchase policies enhancing transparency by requiring more detailed, timely, and structured disclosures of buybacks. Here are 3 key takeaways. 1. A leveraged buyback enables a company to repurchase shares using debt, which can increase the remaining owner's shares by reducing the number of shares outstanding. 2. Leveraged buybacks can be used to improve financial metrics, protect against hostile takeovers, and potentially influence stock prices, but may not necessarily reflect the company's underlying performance or value. 3. The buyback boom has led to increased risk for bondholders and shareholders, and potential tax changes could impact leveraged buybacks in the future. Hope this would help. Thanks for watching.